Jason. March. We're getting there.
Spring is coming.
We're getting there.
Almost done.
When's that pool going to get open this year? When are you going to open that pool up this year?
Mid-March.
Ice bath.
Exactly.
Ice bath for
my wife wants to get it open and crank up the heat.
Yeah, let's crank up the pool in March and drop like $1,000 to go in there for a 15-minute dip. Right?
Exactly.
Speaking of dips, we're going to talk a little bit about the dips in taxes, hopefully, how to save some money. But we're going to get into some tax planning for 2025, Jason. Now, CRA, the beloved Canada Revenue Agency, has come up with their new tax brackets and Canada pension contributions, RSPs, TFSA, all that mumble-jumble stuff when it comes to limits. But, each year income tax benefits are indexed to inflation. Now, a year ago, when we had that record inflation happening, these brackets went up by 4.7%. So, income brackets were elevated so you can make a bit more money and pay a bit less tax. This year, they're using 2.7% as their inflationary number. And again, the increases to the tax bracket thresholds also to amounts to relating non-refundable credits with regards to GSTs and GST benefit and child tax benefits. So all this, by the way, the GST and the child tax take effect on July 1st. All the other tax increases happen right now. So if you kind of think about it in this way, right now with that 2.7% increase, the new federal bracket is from $0 to $57,000 of income. So if you make under $57,000 of income, you're going to pay about 15% federal tax, probably about 5% provincial tax, Jason. If your income is between $57,000 and $114,000, that's the next tax bracket. You pay a bit more tax. If your income is between $114,000 and $177,000, $178,000, that's the next tax bracket. Then you've got the $178,000 to about $253,000. That's the next bracket. And then anybody making over $253,000, well, congratulations. You are the lucky winner because you are going to pay the most amount of tax you possibly can. You're going to work half your year for the government. Congratulations.
Half, yeah.
More than half your year.
More than half
right?
their year. In Ontario, it's what,
53%. So, yeah, so.
That's crazy. That's crazy. Well, on the positive side, sort of positive, the basic personal amount. So this is the first amount of money that you can make. The basic personal amount is the amount of income that you can earn without paying any federal tax. So it used to be $15,000 and now it's crept up. So in 2025, the increase to the basic personal amount is $16,129. So the first $16,000. Now, if you're a higher income earner, of course it gets clawed back. But let's just be nice for a minute and say the first $16,000 that you make is tax-free federally.
But you know what? Again, put it into dollar terms. What does that mean? Well, if you made $16,000 a year ago, you would have paid about $200 federal tax. Mm-hmm. So by the bracket going up to 16, it saves that low-income earner about $200. So there's a bit of savings there. These bracket creeps as they move up. I mean, they're good. They're good. I mean, they're not perfect, but if you get somebody who's a single mom or someone who's on low income, an extra $200 or $300, it's money in their.
Or young kids that are just getting summer jobs and things like that. They're probably not making. They're making close $10,000, $15,000. So if they can pay $0 in tax, then that's a good thing.
Exactly right.
One of the other things that's changing is the rules to the Canada Pension Plan. So still remains a contribution rate. So every employee and employer pays 5.9% of the year's maximum pensionable earnings, which is the YMPE. It's also called the first earning ceiling, so they've added a second earning ceiling. So the increase this year is up to $71,000. So that is the ceiling. So if you make $71,000, you're maxing out the CPP contribution. This year, the maximum contribution that you can make to the CPP is $4,034. Now, that's employee, and then your employer has to pay the same amount. Obviously, as I mentioned, self-employed have to pay double that, 11.9%. So the maximum contribution for a self-employed is actually over $8,000.
So for those out there, when they talk about that $71,000 threshold, what that means is this. If you make $50,000 a year, let's say starting today, and the ceiling for the Canada pension benefit is $71,000, you make $50,000. When you go to retire, the maximum Canada pension might be $1,400 a month, whatever it is. But if you make $50,000 on a 71, you're going to probably get, 75%,
75, yeah,
80%
yeah,
of the full amount.
Of
so
$1,400,
it's important that people understand this, that when they do retire at some point, the Canada pension isn't just, I paid into it for years, I'm going to get the full, $1,200 to $1,400 a month. It's based on your earnings that you which the pensionable earnings that you've been paying into this Canada pension. But Jason, for an owner of a company or a self-employed person, it's a big hit, right? I mean,
11.9%.
Yeah, it's a big hit. $8,000 a year. So if you're making $80,000 a year as an entrepreneur, as a self-employed person, you're kicking $8,000 into your federal pension plan, right?
Yeah, well, you're actually paying more now because they've added that second tier, right? So if you make between 70 and 80,000, roughly 70 and 80,000, 2024 they changed the rules to add a second tier. So now you're paying an extra couple $100. So you're actually paying an extra $396 per employee. So if you're self-employed, you're paying double that. So it's another $792,
right,
if you make 71,000 or over. So, one way or another, they're coming.
They're going to get you, right?
Yeah.
The other increases too are going to be for employment insurance premiums. So right now, EI's raising their rates on employees to 1.64%, up to a maximum contribution of about $1,077. So if you're working as an employee, you're paying into your Canada pension. You're also paying into your unemployment insurance. The one good thing in this report, or there's a few good things here, is that the tax-free limit hasn't changed, so that's not really a good thing, but it is still $7,000. So it was $95,000 in 2024. That was your maximum tax-free account contribution limit. It's now going to be $102,000. And I will say, I remember years ago, Jason, when this first came out, we're like, it's $5,000, $5,500, $6,000. But it's starting to kind of become powerful now, right? You get a lot of people that they put $100,000, they have $100,000 of room in their TFSA, they inherit some money, they buy some stocks, they buy some Bitcoin. Just kidding. They buy something, and they drop it into their tax-free account, and all of a sudden, if that thing goes up 50, 100, 200% in the next 5, 10, 15, 20 years, it's a complete tax-free account.
Yeah, it's great, and the $100,000 as a couple. Now it's $200,000, and we've had some good years on the market. So hopefully people are taking advantage of that $100,000 of room for the tax-free savings accounts. One of the other things that's increased, of course, is the old guy of saving vehicles, the Registered Retirement Savings Plan, the RSP. The limit for 2025 is $32,490, up from just over $31,000. So those are the limits. It's up to 18% of your earnings, up to that maximum of $32,400. So it includes self-employed income. It includes rental income. So that's creeping up as well. We don't talk a lot about RSP room anymore, or as much as we used to. But $32,000 you can put.
Well,
it's away.
Amazing, right? I mean, that was the only game in town 15, 20 years ago, and it was almost like every January, every February, all we did was run around picking up checks for RSPs, and And now it's like, yeah, I'll put into an RSP, I'll do a TFSA, I'll do an open account. I mean, there's other options available, right?
Yeah, exactly. Old age security is one of the negatives. We talk positive and negative. Old age security, the clawback. So there is a threshold. So if you make up to $93,400 in 2025, you get the full old age security. But every dollar over that $93,000 now, you're gonna have it clawed back. It's 15 cents on every dollar that you make. So we do a lot of tax planning to try and keep people under that 93,000, so they don't.
93,000 is the net income.
Yep.
So it's again, you want to be careful. And if you're taking your old age pension, if your income is over 93,000, let's say your income is 125,000 and you're 65, it might make sense just to defer taking the OAS for a year or two, because there's no sense taking it and then having it all clawed back. You're better off just deferring it. So talk to your advice team for that. A couple other quick tax planning ideas as well. So again, we go back to it, right? So there aren't a lot of great ways to save tax in this country. One is the RSP, as we've spoken about. So make sure you're planning your RSP deposits and your strategy. One thing I would say too is that, years ago, Jason, it was always last minute. Here's 5,000. Here's 10. I just love the fact that most clients are just dollar cost averaging in. It's $500 a month. I don't miss it. It's gone. And there's no need to, at the end of the year, try to find it. Again, we talked about the tax-free account. Again, one of the best things ever given to Canadians. Make sure you're maximizing that. And of course, if you have children, it's the Registered Educational Savings Plan. Again, another no-brainer. Trust a guy who has 2 kids on the verge of, I have one in university right now, away at school. I have one going into university this fall. I'm grateful that I was smart enough to, put aside $400 or $500 a month way back, got some great growth. All of a sudden now I'm kicking back going, it's not so painful knowing that I've got, 5 or 6 years of my kids' education already funded.
Yeah, exactly. And we talked earlier about you can make, the kids can draw out of that RESP up to about $16,000-$17,000 without paying tax. So it's definitely a great vehicle, a tax-saving vehicle. On the flip side, some deductions, some credits to think about. Of course, as you mentioned, the RSP contribution, you get a tax deduction. Medical expenses are really important. If you're in a group plan, anything above that group plan that you have to pay out of pocket, keep those receipts for the medical expense deduction. Tuition, education. If your kids are in school, either you or your kids can use that tax credit. So don't forget about the tax credits. It's important.
Well, it's amazing, right? I mean, we have accountants and we have people that do our taxes, and these are things that I don't even know much about. I'm not really sure how some of these tuition credits work and medical expenses, but if you don't have a person doing your taxes and you're doing it yourself, this is one thing that I can see them completely missing on the deduction side. When it comes to effective income splitting techniques, and again, there's nothing better than you retire, you've got some wealth, and instead of getting completely eaten alive by tax, by taking it yourself, you can split some income. The spousal RSP, again, really important. If you're out there, if dad has a pension and mom doesn't have a pension, then make sure mom has the RSP, dad has the pension, vice versa. Make sure too that you don't end up having, dad has $1 million in his RSP, mom has nothing. You want to make sure you spousal split your RSP. If you're a corporation, again, you might want to consider a family trust. Again, talk to the accountant team, talk to your advisors, see if a family trust makes sense. And on the business ownership, one of the good things right now is when you structure your business in a way that if at some point you can sell your business, Jason, then on the sale of the business, the first $1.25 million, if you sell shares, is non-taxable. So again, if you're putting together a business and you've got shares, then of course at some point down the road that could be a really big windfall for those that are at the point now in our age where we're seeing it 55, 60, 65. They've been running their business for 20, 30 years. Are looking at ways to get out. And the nice thing is that there's all that built up value in their shares. And again, with this $1.25 million that you can take out tax free by selling the shares to a competitor or a third party, not a bad way to go.
Yeah, for sure. Again, proper planning, right?
Yep.
One of you talk about business owners. One of the things that's important to think about, of course, again, another strategy is incorporating. So everybody thinks business owners, they're all incorporated, but that's not necessarily true. They've got partnerships, they've got sole proprietorships. So talk to an accountant or advisors about possibly incorporating. When and if you do incorporate, there's some really great effective tools now for the business owners to look at retirement plans, the individual pension plans, and now a personal pension plans, which are just absolutely outstanding ways to help the business owners look for ways to retire.
Yep. If you're an incorporated business owner, you're a doctor, you're a dentist, you're an accountant, you're a lawyer, you're incorporated, you're a professional, whatever it may be, the pension plan structure, the IPP and the PPP, the personal pension plan and the individual pension plan, these are absolutely slam dunks. And there were some rule changes a few years ago, back in 2020. CRA, as difficult as they are to deal with, did give some small business owners this flexibility. So our advice is, give us a phone call, because this is a great tool. When it comes to the estate planning consideration, again, wills and estate planning, make sure you've got your wills, make sure you have your estate plan. You don't want to give the government more tax money, more fees, probate fees than you have to. Again, hopefully when you're doing your estate plan, you're looking at the potential of tax down the road. And again, we highly advise folks to look at using life insurance as an estate tax plan. So that's... And again, Jason, I've almost never seen anyone who has a tax bill by using life insurance doesn't benefit. There's a much bigger benefit than just saying, well, my dad's going to pay $1 million in tax and I'll just pay $1 million in tax. Make sure you use life insurance. Also, too, make sure you're looking at your beneficiary designations, because what you don't want to do is have nobody on your RSP or possibly your pension. You die, that money gets taxed at source in your income. You want to make sure it passes on to your spouse.
Yeah, for sure. And some of the key takeaways: stay informed. You talked about changes, the tax changes in 2020. It's important to stay up to date on some of those changes. Consult a qualified tax professional. Plan strategically. The accountant, the financial advisors need to all be on the same page. It's good to sit down with your financial advisor and have conversations throughout the year. And of course, again, just seek professional advice, seek expert advice. We're here to help. It's not just about having an accountant or a lawyer or a financial guy. Have them all working together.
There's an old saying, right? If you think good advice is expensive, you'll soon find out what bad advice cost you.
Yeah,
right.
Exactly.
So it's important to get good advice. So we are in March. It is tax season coming up in April. Get prepared. Get a good accountant. Get a good tax preparer. Look at your deductions. Make sure nothing's missed, because it's amazing, Jason, how many people just miss good ways to get back some of their hard-earned tax money. Jason Pollock, have a great month. Thanks again.
Thank you, as always.
Stay well, and if that pool gets opened up and it's up to 92, you can give me a call. I'll come in for a dip, right?
You can pay for it too.
Yeah, exactly. Send me the heating bill for the month. Right? I might have to remortgage my house. But have a great month through all of our listeners. And again, don't forget, we're on the YouTube network. We're on Spotify. We're on Apple iTunes. Again, thanks for tuning in.